is this? What is this? Let's bring this microphone into play. Get the big head on here. Here we go. How you doing, friends? It's Ernie here, and this is the 90th episode of 0 Days to Expiration. 90 whole episodes. It seems only like yesterday that I started this podcast. Pretty soon we're going to have 500 episodes. Well, that'll be a while. But 90 episodes. And every episode, I believe, has exceptional content that you can use for your trading, and in particular, trading the 0DTE. I should say the 0-DTE, because that's what we do. We are the 0-DTE.com. And if you'd like to try out the service, now this isn't an alert service, by the way. Let me be very clear that we are not an alert service. We are not here to pump out alerts and then have you follow like a monkey. Yes, that was a monkey. And blindly put on the trades. No, this is an educational service. I am your coach. I am your mentor. I am here to teach you not some trading strategy, although there is a trading strategy. I am here to teach you an entire system. And it doesn't matter if you are new to options trading or if you're a seasoned professional. I'm going to show you a system that can make you a lot of money using very little cash and zero anxiety. That's the biggie right there. Zero anxiety, stress-free trading, and very, very gratifying. I must say that. So if you're thinking of joining this service and the first thing you want to know is, where are the alerts? Where are the alerts? I'll show you where the alerts are. But I'll also tell you that that's not what we're here for, man, woman, whoever. We're here to learn. We're here to experiment. We're here to explore. We're here to gain wisdom. We're here to make money. So let me make that perfectly clear. This is not a game. We are all here to make money, and we want to make serious money, and we want to have fun doing it. We do not want to feel that pain that most other traders feel, the vast majority. And one of the reasons why one might feel pain when trading is what this particular episode is all about, and that is coming face to face with the pattern day trader rule. You could be flagged. Yes, flagged. Flogged, flagged. It feels like the same thing. A pattern day trader, if you do not follow the rules. You must follow the rules. If you don't follow the rules, you could lose your ability to trade for 90 days. That's quite a blow. You've spent a lot of time and effort and money and sweat and toil to get all set up and do this thing. You might even be making a living at it or trying to make a living at it. And then all of a sudden you're flagged. And you're put on the sidelines for 90 days. 90 days. And once you're put on the sidelines, you can't go to other brokers and try to get off the sidelines. It doesn't work that way. However, if you had planned ahead, you could do that and try to avoid it. That's one way. But let me explain what the pattern day trader rule is. This applies to day traders, as by the name goes. And what that means is that, let's first define what a day trade is. A day trade is when you open an asset in a trade, open a position, and then close that same position in the same day. That same session, you close it. That is one round trip trade. Now, the way you get flagged as a day trader is if you do 4 of those in any 5-day rolling period. So you take any 5 days and you make that your mask and you just put it across the calendar. And if within any 5-day rolling period, business days, I would imagine, any 5-day trading rolling period, and you make 4 trades like that I had described, you opened it and closed it in the same day. It could even be the same asset, like you're doing the SPX. If you do it, just because you're trading the SPX and you do it, say, a couple of times a day, that's 2 trades. Now, you could put on 2 positions or 2 contracts at the same time and make it 1 trade. They don't count that as 2. So you're allowed 3 of these in a 5-day rolling period. So that means that you have to be very, very careful. Now, there are conditions, of course. This is specifically for people who have underfunded accounts. What is an underfunded account? An underfunded account is one that has less than $25,000 of buying power. $25,000. So as long as you have more than $25,000, this rule doesn't apply to you. So that is one way that you can avoid becoming a pattern day trader. And that is to, now, let me be very clear. It's 25,000 of available funds. Available funds. So if you have positions on, you have to subtract that from there because you no longer have 25,000. If you started with 25,000 and you have a couple of positions on, you no longer have $25,000 of available funds. Also, if you put a trade on and then you close it and you're waiting for it to settle, that money's tied up. Again, you no longer have $25,000. All of these rules. And you have to follow them. Otherwise, you could find yourself in the hot seat. Flagged! Flagged! Flogged! With the pattern day trader rule, that means you're a terrible person. That's what it means. You're the worst, most awful kind of person. A day trader. Some people think day trading is illegal. You're a criminal. You don't want to be a criminal. All right. So now, what I'm trying to do to impress upon you is how bad it is to become a day trader and then violate these rules. The reason why it's bad is because you are putting not just you in peril, but you are putting the people who are giving you a platform to trade in peril. Because ultimately they're responsible. It's their money. It's their margin. They're guaranteeing these trades on the open market. And so these rules are not for you. They're really for the broker. Everything is for the broker. Everything. To think that you come into trade on a platform and somehow you are the king, you are the customer is always right. You couldn't be so wrong. You are not right. You are nothing. You are there for one purpose only, and that is to create commissions for the broker. And if you do it in such a way that costs them money, oh my God, you will be flagged. That's just the truth. You are nothing. You are a pissmire. You know what a pissmire is? It's an ant. A tiny little ant. Little ugly ant. That's what you are. If you become a pattern day trader. So there are ways to get around being a pattern day trader. I had already mentioned one, and that is to have at least $25,000 of available capital or buying power. Then you never have to worry about it. So just become rich. Put crap loads of money into your account and then trade all the time. Day trade. This only applies to certain types of assets. It doesn't apply to futures. With futures, you are God. You could trade 1,000 times in a day and never violate the pattern day trader rule. But you trade the SPX, bam! Bad boy. Trade any stock, bam! You're done for. Just the way it is. Futures, on the other hand, you're good as gold. Trade to your heart's content. Now, this applies for options as well. So if it's options on futures, you're good. If it's options on the SPX or stocks, you're bad. You're assumed bad. So what you have to do is you have to stay out of the limelight by not putting on 4 day trades in any 5-day rolling period. Now, I'm sure that being an enterprising trader and entrepreneur, that you're thinking to yourself, there must be a way around this, Ernie. There must be some way I can defeat this beast. And you would be right. There is. However, it's not trading for Robinhood or Webull, because they don't even care about that rule. They'll slap you before that rule comes anywhere close to you. However, you can do some pretty tricky things. Here's one tricky thing. One is that you could allow the trade to expire. So let's say that you're in an options trade on the SPX, like what we do here at 0-DTE. You could put that trade on and allow it to expire at the end of the day. Now, of course, if you're not in profit, you're going to lose money. If you're in profit, good on you. You'll be cool. And you will not be tagged with a single instance of a day trade because you allowed it to expire. You did not close it before the end of the session. That's one way that you could do it. All right? Now, of course, some people say, well, you could swing trade too, but then you couldn't trade 0-DTE. There's no such thing. Well, actually, you could. Instead of taking the trade on the last day, you could take it the day before and then close it that. But then it's not within a 1-day period, and it's not really the thing. So that's not really a solution. But there is one very, very tricky way that we have that you could trade all you want. Now, consider that you can let it expire. Think about how you could let something expire and simultaneously lock in the profits should you have profits. How could you do that? Now, first of all, with our strategy, letting it expire, even if you're not in profit, is not a big deal because we trade asymmetric positions. What does that mean? That means that we put on tiny, tiny little risk with the potential for a huge, humongous profit, well, comparatively so. Minimum 1 to 5 risk to reward. Usually more like 1 to 8 or 1 to 12 or even 1 to 20 risk to reward. So when we put on a trade and it's in a loss, we're not so really worried about it, and we're not sitting there trying to manage our risk because that is the risk that we took. And so we allow it to just go its merry way, and that's fine. And so we don't get that pattern day trader flag. However, there are some times where we'll want to take off the trade if we're, for instance, very close to a pinned trade. Now, a pinned trade is where you're just about at the very peak, the maximum profit that you could possibly make, and it's getting down to that end of that day, and the gamma risk is going wild, so you want to make sure that you capture that max profit before price starts moving and drifting away, and so you want to get out of the trade. Of course, that will result in a pattern day trader flag. If you do not follow this very, very ingenious, fantastic way of getting out of that trade. Now, you're not actually getting out of the trade. In fact, what you're doing is you're adding another trade. And this other trade is the exact opposite of the trade that you put on. Now, this wouldn't work with just an open call or something like that, or just a stock where you trade 100 shares. You can't just put on an opposite trade and say, oh, I'm going to go short 100 shares, because that's effectively getting out of the trade. However, with our strategy, we trade butterflies. Now, what is a butterfly? A butterfly is a type of options strategy that has 2 longs and 2 shorts of a particular type. Either it's all calls, so it's 2 long calls and 2 short calls, or the butterfly position is all puts. 2 long puts or 2 short puts. Now, everybody knows that when you put on an options trade, the way you take it off is that you essentially put on the exact opposite, or you sell it. So for all the longs that you put on that you bought, you sell them. right? You go short them. You're not long them. For all the shorts, you go long or you buy them back. Of course, if you do the same option type, a call or a put, then it will result in a pattern day trade. However, here's the real kicker. A lot of people don't realize this, but if you took a butterfly, let's say a call butterfly, and it had certain criteria. You had your short strikes, and then you had your symmetrical wings, right? There may be 10 points on either side. And so let's say it's a 44.25, 44.50, 44.75. The 44.50 would be 2 short strikes. The 25 and the 75 would be 1 long each. And they're calls. Now, if you were to create the exact same criteria trade, but instead of using calls, use puts, that trade would be exactly the same in every way as the other trade is from the perspective of risk to reward. If you put them on at the exact same time, they'd have the same debit, the same maximum profit. Everything would be exactly the same. So here's the trick. The trick is that you go into a butterfly long. Let's say you put on a long call. Butterfly. 2 long calls and 2 short calls. Now, you're going along your merry way, and during the day, you're in profit. You've got a lot of profit. You put $100 down, and you're up $800, which, by the way, is a very common occurrence in the zero-DTE paradigm of our way of trading. As a matter of fact, this past Monday, we had all kinds of trades like that. As a matter of fact, I even talked about one and showed it in its fruition in our live stream on Monday. And we'll have another live stream today showing these trades where I made a lot of money by closing one of these trades. But I had plenty of money in my account, so I didn't have to do this little trick. The trick is, if you want to get out of that trade and lock in those profits, what you do is with that call butterfly, you put on a put butterfly with the exact same parameters. But instead of going long the 2 wings and short the center strikes, you do the exact opposite. You go short the 2 wings and you go long the center strike, essentially creating the inverse trade, but with puts. Now it has the exact opposite effect from a risk to reward point of view. And if you were to put both of these trades on simultaneously, what would result in your analyze window and the profit line would be a flat line. Now, if you did this after you've made profit, and then put this put trade on after you've made that profit, the opposite trade, it would essentially hedge that call trade perfectly. 100% hedge. And there might be a couple of cents difference. Never much more than that. It's literally a few cents difference. There's always some skew or something that makes it just a little bit different. But if you put that put butterfly, that short butterfly, on top of the long call butterfly, it will flatline it and lock in your profit right there. And then you can let both of them expire. And therefore, neither will be considered a day trade. You have just defeated the man. You are the master of your universe. You can say, PDT, go take a hike, because I don't need you. All right, so now you know how to defeat the pattern day trader rule in zero-DT. Now, there are a lot of moving parts here, and for some people, this might not make a lot of sense. And once you're in a platform and you can right-click and bring up these strategies with just a couple of clicks of a mouse, it's really, really simple to put on. You put it on, it levels out your gains, you're there, you're good, you let it expire, and you're sitting there like a pig in crap, and you've just put on $100 trade and you made $800 and you only have $500, maybe $5,000 in your account, and you say, oh, I made nearly 20% of my account today. and I didn't get tagged with a pattern day trade rule. Beat that. Beat that. That is awesome. Got a question from the Peanut Gallery from Zero Gravity. He's asking, you would think Pelosi would get flagged for insider trading. Oh, I don't know what that has to do with this, but it's funny. So anyways, that's all about the pattern day trader rule. It's how to defeat the pattern day trader rule. It's how we do it here. Not all of us, but those that have smaller accounts. Do it here and trade with reckless abandon because we know that the man has nothing on us. I hope you enjoyed that. I hope you've learned something, and I want to say we'll see you. For those that are live here, hang around because at 3:30 I'll be coming on live. Of course, this isn't live for you people listening on the podcast. This is much later. But at 3:30 we will be live because I am broadcasting live right now on YouTube. We will be there trading the 0DTE final hour trade, and you may in fact see us demonstrate this PDT killer. That's what it is. It's the PDT killer, the Brit killer. All right. Thank you very much for hanging out with me. I really appreciate it. Yes, Damien, all is well. Thank you for asking. Peace to you all, and we'll see you next episode, which will be episode 91, almost to episode 100. That's going to be a wonderful thing. Thank you. Peace. Take